Okay, now we're going to finish up Unit 6 with a discussion here of the material in Chapter 16. Chapter 16 is a chapter on pricing and credit, two very important topics for us to talk about. Here's the definition on price. You can read that as well as I can, but let's just talk about this for a second. Price is set too low, means I'm going to lose some revenue, perhaps even lose money, profit. Price is set too high, I can lose revenue. So I have to figure out now what is just exactly the right price for me to set my product in a very dynamic market. We'll talk about this some here in just a little bit. When I say dynamic market, I mean a set of dynamic relationships. They're non-linear relationships. We'll see this in just a second. Credit is an agreement between a buyer and a seller that provides for delayed payment. There's advantages for both the seller and advantages for both the buyer for credit, and we'll talk about those in a moment as well. Here's two situations to look at. We have situation A and B. We have a quantity of 250,000 units sold in both cases, but in case number one, situation A, the price is $3 per unit. In situation B, the price is $2.80 per unit. So by reducing our price by 20 cents, we reduce our revenue by $50,000. That could be very significant for a small business. So you can see that slight changes in pricing can generate big changes in the amount of revenue that we will see in our small businesses. The total cost structure we're looking at here is what we're calling the cost of goods offered. Later on, you'll hear us calling this the cost of goods sold when we start talking about some of the financial reports. And then we see our selling cost, which is sometimes will be related to our gross margins a little bit later on, and then our overhead costs. And you can see what those examples are that goes into each one of those buckets. So let's move into a little bit more detail now on our cost definitions. Total cost is exactly what it says is. It's the cost of everything that goes into producing a product. Variable costs are only those costs that vary with the quantity produced or the number produced of an item. Fixed costs are, the costs that remain constant as the quantity of product or sold varies. So what that means there is that fixed costs are those costs that are there no matter what, how many products you sell. And things such as rent, utilities, the cost of your equipment, some of those costs remain fixed. Average pricing, now we want to look at this a little bit closer because sometimes there's a temptation to price your products on an average basis. And that's a very treacherous area to get into. It's an approach in which total cost for a given period is divided by quantity sold in that period to set a price. So let's look at a couple of examples here. Here's a cost structure of a hypothetical firm in 2011. Sales revenue was 25,000 units at $8 or $200,000. Their fixed costs were $75,000. Variable costs were $50,000. The gross margin was $75,000. And so their average cost then becomes the $125,000 total cost divided by the 25,000 units, or $5. And you can see here that this company more than likely made a profit on this sales volume. Now let's go to a different case where the sales volume is less. I'm selling 10,000 units at $8, and I can see now I move from a profit position in the prior case to a loss position in this case here. And so now my average cost is $9.50. So you can see that the average pricing scheme overlooks the reality of higher average cost at lower sales levels. So what's causing that? Well, it's the variable costs that are causing that problem. My variable costs vary with the number of units, and so here with the units reduced, my variable costs have a bigger impact on the total cost of the product and the resulting loss in this case. So be very careful of average costing. Now let's look at elasticity just for a little bit. This is a different topic. We're going to shift to that. Elasticity of demand is the degree to which a change in price affects the quantity demanded. Elastic demand says that as I change my price, demand changes. In most cases, if price goes down, demand goes up. And you see that red arrow right there. Price is coming down, demand is going up. In an inelastic demand curve situation, that's where no matter what I do to price, the demand remains roughly the same, and that's the blue vertical line. I'll sell the same number of units irrespective of what the price of the unit is with certain limits. It has to be practical on what we're talking about. But that's the difference between elastic and inelastic pricing or demand situations. Pricing then becomes something that's very, very important for you to consider as you begin to enter a marketplace, because this helps determine what your competitive advantage is going to be. Customers will demand and pay more for a product or service that they perceive as important to their needs. So prestige pricing then becomes setting a high price to convey an image of high quality or uniqueness. We see that a lot in the marketplace. I can identify 2 or 3 products right now that are prestige products, and they operate in exactly this pricing scheme. Customers associate price with quality. It's just natural. We all do that. Sometimes it's valid, sometimes it's not valid. Markets with low levels of product knowledge are candidates for prestige pricing. I see I see this in a lot of markets, and I'm just amazed at it sometimes, that people will pay the prices they pay for these products simply because it's more perception than anything else. The break-even analysis is where we now try to determine when our cost and revenue estimates or cost and revenue numbers will match up to get us to a break-even status. So what that means is that my revenue will cover exactly my cost, and there's no extra. That's called break-even. So what are the steps? Well, the first thing we're going to do is we got to look at all these revenue cost relationships. In the formula below here, the break-even units sold is equal to the total fixed costs and expenses divided by the selling price less the unit variable cost and expenses. Now just take a look at this equation just for a little bit. At break-even, my total fixed costs and expenses is going to divided by my at break-even, or determine the break-even units sold, I divide my total fixed cost expenses by the difference between the selling price and my unit variable costs and expenses. Okay, so let's look at a couple of curves here. The curve on the left plots your sales. That's a sales curve that starts at 0 and goes up to on top of the blue line there. That's the $12 price sales curve, and for each price level we'll have a different sales curve. The blue line just below that and above it, below the break-even point, is my actual profit loss curve. So I have a fixed cost here of $300 in this case. That's the number on the left. When I start selling product, I'm beginning to recover that $300 fixed cost. And once I get to the break-even point, my profit becomes positive, and my sales moves that profit line above the cost line. Below the break-even point, I'm in a loss mode. Above the break-even point, I'm in a profit mode. So how do we calculate that? Let's look at it. The total fixed cost and expenses in this case is $300,000. So I'll put that into my formula. The unit selling price is $12, and the unit variable costs and expenses are $5. Well, I think I calculated that just a moment ago, I believe. But anyway, so we know what our variable costs are. It's $5. So when I calculate the break-even point, I get a total number of units of 42,857. So when I sell 42,857 units, I have hit a zero loss, zero profit condition, a break-even situation. Now, let's go over to the right-hand curve and look at a situation where I have various pricing price marks. I have a $20 price mark, a $12 price mark, and an $8 price mark. And you can see I still have that total cost curve going up. That's the red line. And with the $20 price, my break-even point now is a little bit lower, but I'm going to sell fewer units because the price is higher. With my $12 price, you can see the break-even is where it was a moment ago, roughly. And with the $8 price, my break-even is much higher, but I've got to sell a lot more units in order to get to break-even. And so now the challenge becomes for us to be able to figure out exactly where do we want that break-even point to be and where can it be in order to maximize our profit. So we look at sales volume that's going to, and demand that's going to allow us to do that. Look down here at the contribution margin. Has a difference between the unit selling price and the unit variable cost and expenses. Okay, that's the contribution margin. Now let's look at the situation where we're starting to look at the dynamic relationships between pricing and cost, and we'll find out that price has a variable impact and influence on demand, and so we have to be able to adjust for that as we do our forecast or our pricing analysis. So now let's look at a dynamic situation where we have a sales curve that's generated from our demand schedule. So for every price level, there's going to be a certain demand, and so we can plot out that demand. That becomes our demand schedule. Now, when we set if we set the sales price at $20, we'll never get to a profit situation. We'll be at a total loss. If we set the sales level at $12, we will get into a profit situation. If we set the sales level at $8, we'll get at that level we'll get beyond a profit situation. So we have to be very careful how we set our price in order to maximize the area underneath this dynamic sales curve right there. Now let's look at the ways we can kind of set our prices once we know what our costs are. There's two. The markup pricing is where I simply take a markup percentage to cover my operating expenses, my price reductions that will come in the future, and desired profits. So that's the things I consider as I'm setting my markup. Now I can mark up to selling price, or I can mark up to cost. Either one is okay, but I've got to make sure I understand, if I'm analyzing a company, how are they marking up their price. If it's my company, I've got to have a consistent policy of how I'm going to mark up to determine what my price is. So that's just kind of a little tidbit to think about. Make sure you're aware of whether it's marking up to cost or marking up to price. There's a lot of different pricing strategies that you can look at: penetration pricing, follow the leader pricing, and so forth. You can see it on this chart. If I'm entering into a market where there's already significant competition, then I may want to do some penetration pricing, the pricing that will allow me to penetrate that market. Follow the leader pricing is where I'm simply following the current market leaders in a market segment. Dynamic pricing is where my pricing changes depending upon which segment or which market I'm playing in. What the market will bear is a price that simply says I'm going to try to figure out what the customers here will pay for, and that's what I'm going to charge. It has nothing to do with my cost. All I know is it puts me in a profit position, and I'm going to charge what I think the maximum price is the market will bear. Price lining is something you don't see a lot of, but a good example of price lining is where is a men's store. If I go into a men's store and I want to buy a jacket, then the salesman will show me jackets priced at certain levels, say $400 level. This rack has jackets priced at $500 levels. This rack has jackets priced at $600 levels. That's called price lining. And so I simply line up my products by whatever price I want to list them at. Variable pricing is where I price it at variable levels. Most notably, this occurs where I have multiple levels of distribution occurring, and I'm actually selling my product to distributors. And so if I've got a consumer product, I've got to make sure that I'm selling the product to my distributors at a level that allows them to be consistent in the marketplace and to make a profit in the marketplace. Skimming pricing is where I'm simply going to maximize my profit for as long as I can, and then I'll bring my price back down into a competitive range. Let's talk a little bit about credit now. The benefit of credit to borrowers, this is what this chart shows right here. You can see what it does. If I'm the borrower, I have a small company. If I have credit, that provides me with working capital that I can use now to begin to grow my business. We'll define working capital later on, what that really is. But anyway, the credit allows me to have working capital, allows me to keep operating my business and to grow my business. There's several other advantages here. You know, you get better records of your purchases and so forth. All those things are important, but the key one here, right here, benefit, is it provides me working capital. Most of the times, the credit we'll see in our small businesses is the 30-day supplier credits that we get. There's also some advantages to sellers. If I'm selling to my customers and I offer my customers a 30-day credit system or scheme, then what that does is that encourages those customers to buy from me, and so that's going to increase or enhance my sales volume. So credit to sellers enhances my sales volume, but there's a potential downside there, and that is that I have to be very careful in how I offer credit to sellers and be selective in that. I do not want to offer credit that I'm not going to ever be able to collect. And there's some other advantages here too. You can look at these as we flip through these charts. Selling on credit. These are some factors that if you're going to sell on credit that you really need to think about. And this is what this is a process every bank goes through when it's thinking about making a loan. It's a process that oftentimes financiers will go through when they're thinking about giving you credit for your company. What type of business is it? What kind of credit policies do your competitors have? What is the income level of your customers? What is the availability of working capital? So as you begin to look at how you're going to sell on credit, what kind of credit policy you're going to have, you've got to take into account all of these things and more when you start deciding on what that policy is going to be. Well, there's two types of credit: consumer credit and trade credit. Consumer is exactly what it says. That's the credit that you and I see on what we use with our credit cards all the time. Trade credit is the credit that occurs between a company and its buyers, or a seller and its customers. And that oftentimes trade credit will have terms with it. Terms like 210 net 30, which means that the buyer gets a 2% discount if the invoice is paid within 10 days, and otherwise it's the full amount that's due in 30 days. So that's 210 net 30, 2% discount if paid within 10 days, a full payment after that, up to 30 days. Now, you say, well, that's not very much. We're going to show you a calculation later on that's going to blow your mind, but you're going to see that if I'm operating a company and I can take those little tiny discounts on the things I'm buying, it makes a huge difference in my cash flow at the end of the year. Here's some kind of traditional schemes for evaluating those people that would like credit with you. Can they pay? Or will they pay? When do they pay? Can they be forced to pay? Those are questions you have to ask. And unfortunately, a lot of our buyers will have very good payment records. They pay on time. They pay exactly as they agreed to pay. And then sometimes you'll have buyers who they pay, but they're always late, or they're taking their discount after the discount period is over with, or just constant kind of nibbling away at the relationship. Those are ones you'd like not to have. Unfortunately, you will have those, and you have to, sooner or later, you'll have to deal with them. The traditional 5 C's of credit are character, capital, capacity, conditions, and collateral. These are the 5 C's that all major lenders use to qualify their folks who are taking loans with them. So where do I get my credit information on individuals? I can get it in a couple of places: their credit history, and then also on the D&B, Dun & Bradstreet information reports. I can also get it on their business by looking at their financial statements and what their customers are saying. I mean, their other sellers are saying about them, what their bankers say. Sometimes you can get it from credit bureaus or trade credit agencies, and sometimes you can get it with online credit data. But there's ways to get information on businesses and their credit practices. And you want to make sure that before you offer credit with your business that you understand what that customer's track record is, what their history is. It's the same way for individuals. I want to know what their history of payment is before I'm going to offer them credit. Your bank goes through this same process every time you apply for a loan at your bank. Now let's shift our discussion just for a little bit here, because I want to show you something that we'll talk about more later on, but this is kind of an introduction of this concept to you. This is an aging schedule for accounts receivable. It's an example. It's hypothetical. Now, I want to point out some things to you. If you're operating a business and you're offering credit, what that means is I'm now going to be showing accounts receivable. Accounts receivable are the credit accounts. Those are accounts that haven't been paid yet. In other words, they're receivable. So when I run a schedule, an aging schedule, I'm going to line up all of my customers by account numbers across the top, and then I'm going to look at how large is their bill and how long has it been outstanding. So I look at customer 1 right here, He's got a $50,000 bill that's been outstanding for 15 days. He's not overdue. And so forth. I can go right down the line here, customer 2, 3, 4, and 5. And so I can see over in the right-hand column, this is my total accounts receivable numbers aged. So within 15 days, I have $60,000 due. Within 30 days, $40,000 due. So I've got $100,000 outstanding right here that should be coming due shortly. Then I've got another $100,000 that's overdue, longer than 30. And if I want to say, well, I'll cut them a little slack, I'll go up to 60 days, I've still got $60,000 that's overdue. So that tells me as a business manager, I've got to go manage these accounts. That's $60,000 of my money that my customers are holding and refusing to pay me. So I've got to work those problems out and get those bills paid as quickly as I can. That is cash flow to you. The number one rule for entrepreneurs, by the way, is cash is king. Remember that. Cash is important. And the way you get your cash optimized is to manage your accounts receivable. Stay on top of accounts receivable. Most small businesses are reluctant to manage this aspect of their business. Why? Because sometimes it's going to get confrontational, and you're going to be going to customers who are slow pay and say, I would like for you to pay. And occasionally you may have to go to a customer and say, I can't afford you anymore, and I really am going to request that you buy your stuff from somebody else, maybe our competitors, and they can deal with you for a while because it's not worth it for me to deal with you. And so sometimes you've got to make the split and tell the customer, you know, I love you, man, but I just can't afford to do business with you. So now I summarize here what's not due beyond the discount period on all of these with customer 1, 2, 3, and 4, and what's not due that's still in the discount period. Okay, now the total overdue occurs right here. So for customer 1, his total overdue is $50,000. I don't think so. I think that's a typo, so it should be 0. The total overdue for the customer 2 is $30,000. He's got $20,000 and just kicked past 30. $10,000 is at 90, so he's got $30,000 overdue. Remember, that should be 0 right there. $80,000 for customer 3. Well, it really should be $70,000 because this $10,000 is not overdue. Customer 4 is $40,000. Customer 5 0. Then you've got, look right here on customer 5. He's beyond the he's not due beyond the discount period. They're showing $130,000. That should be right here in this column. So there's a typo here as well. But you get the picture. By doing this aging schedule, I can see how much is overdue right now that I need to collect, how much is beyond the discount period by customer, and how much is still due within the discount period by customer, and how am I rating these customers, A, B, C, A, so forth. So customer 1 is an A rating, customer 2 is a B rating, customer 3 is a C rating. Which ones am I going to pay special attention to? B and C. Those are the customers that are most likely to give me some trouble. The A rating customers say, hey, they pay, even though they may be a little bit late right now. They pay. I count on getting my money from them. But B and C, not quite so. I might have to manage those. So this aging schedule gives you as a business owner a really good tool for managing your accounts receivable. That's your money that you have loaned your customers for 30 days that they need to pay you back. So how we manage the credit process, well, an important part of how we manage it is our billing collection procedures. And again, this is part of something that most small business owners don't like to deal with because it sometimes leads to confrontation and sometimes ill feelings. But you have to kind of shore up your courage and say, hey, we're going to notify people in a timely way because, one reason it's difficult because a lot of these people are our friends. We're going to notify people in a timely way that they need to keep their bills current. We will warn them later on if they don't pay their bills that we're going to turn them into a bill collector or a credit company. And then we've got to keep track of how many bad debts we really have. And buried in this policy, at some point in time, you'll have to come up with a bad debt write-off policy. When do we just give up on them, write them off, turn them over to a bill collection agency, and assume that we're never going to get anything from them and count that as a loss? So all those policies have to be present for you and how you manage your company. And for small companies, this is difficult. It's not a pleasant thing to do, but a good, solid manager in a small company will make sure they take care of this aspect of their business.